Okay, good morning, everyone, and welcome to Macarace's ECB Prep with your host, Tony. Hopefully, you can see and hear me clearly. Do let me know if you do have any issues with the sound, and then we'll kind of edit those. But let's get straight into it. We don't have too long. Remember, we've got the rate decision at 8:15 a.m. Eastern Time, rather than what it used to be at 7:45 a.m. Eastern Time. So let's get into it then. So what is the deposit rate? So this is one thing that has been a main focus for a lot of traders and has been cited by different central bankers from the ECB as as to when rates could be raised. So the deposit rate just is the first interest that is paid by the ECB to banks having deposit. For the moment, it's the opposite because the rate is negative, and that is hopefully, of course, going to change today, where you will start to be, we'll get to 0.25 minus 0.25% from minus spot 5%. But the key thing is just the amount of interest the central bank pays to commercial banks for holding money into in the ECB, right? So if the commercial banks provide liquidity to the ECB, then the ECB will just provide them an amount of interest in return. And that is the deposit rate. So other than that, so the ECB, again, just where banks can place their excess reserves and earn an interest rather than what is usually 100 basis point, 1% below the main refinancing rate, which establishes a floor on the interest rates, since no bank will lend money out unless they can get something in return at the deposit facility. So again, a reminder with the base rates. Emil says, do we have an exact time they're releasing the new rate? Yes, 8:15 a.m. Eastern Time is the exact time. We're just going through the prep here before that because we've got quite a bit to get through. So carrying on then, where is the economy at the moment? So inflation at a record high at 8.6% versus 8.1%. The S&P manufacturing PMI at 52.1, slightly better than the 52 on the prior release, so still showing that there's an expansion within the manufacturing sector within the Eurozone economy. The S&P services PMI, or for that, the final read came out at 53, which is also better than the prior 52.8. Consumer confidence, which came out yesterday, the final bit of data was at minus 27 versus minus 23.6. So yeah. So with that there, so the consumer confidence prelim data then at minus 27 versus minus 23.6. So slightly worse than had been compared to the prior figure. Then carrying on. So the economic sentiment also unchanged at 104 versus 105. And the German IFO Business Climate Index, or just a measurement of how confident German businesses are from a business perspective, at 92.3 versus 93. And then the German ZU economic sentiment, or from an economist's point of view, how confident they are, was at minus 53.8 versus minus 28. So off the back of that data, just to add some more detail, we did see some selling and weakening from the euro off of the back of that worse than expected German ZU economic sentiment data. So usually you don't really see huge moves or that big of a move from the Eurozone, from the euro off of the back of the Eurozone ZU economic sentiment data. But because of the huge difference that they had caused a bigger move in the euro off the back of that. Then the German CPI year on year at 7.6% versus 7.9% the prior. And German HICP German HICP year on year, or what the Eurozone or the ECB prefers to measure inflation, harmonized, comparing it to all the other nations, was at 8.2% versus 8.7%. So overall, the harmonized data itself showing that there may be a slowdown in Germany's inflation, which could lead to the ECB's at some point later down the line maybe slowing down on the rate hike decisions. But that's only 1 month's bit of data. We don't have a lot more data that we need if we're comparing it to the US, where we had 1 month of slowing down of inflation, and then they jump back up. So we can't just take 1 month's better data as an indicator for what's going to happen the following meeting. Galaxy One says Salam. Celan? I think that says Celan. Maybe I'm reading it wrong. Anyway, so the previous ECB meeting then. So the ECB had said that they see 2022 inflation at 7.1%, considering the May HICP reading, again, which was much higher than expected, and another new record in inflation. ECB forecast assumes that 2022 oil price of $105.08 a barrel, at $105.80 a barrel, 2023 oil price of $93.40 a barrel, and 2024 oil price of $84.30 a barrel. So the key thing is that they're expecting 2022 to continue to see levels of crude oil and oil prices above $100. And then in 2023 to ease. So of course you have the elevated prices from the Russia-Ukraine conflict that has had an impact on crude oil prices and energy prices and different assets, not just crude oil, but also the stock indexes and currencies and bonds and gold as well. So that's the key thing is that you just need to understand is that we need to know that it's just that they see elevated oil prices, and of course, if you see elevated oil prices above $100, then according to some economists, then that means that of course those businesses that rely and countries that rely heavily on crude oil are going to have to start paying more or having to increase prices for the goods and services that they would provide using energy. Then Lagarde said that if necessary, the ECB can deploy new instruments to tackle fragmentation. So the key thing for them is that they don't want different areas of the Eurozone economy where you have some countries that are doing well after the first rate hike decision, tightening monetary policy, but then there's a mix of other nations that are not doing well or handling higher interest rates from the central bank or maybe tighter monetary policy. So that's a very, very big issue that the ECB has to face, because of course you have Germany as the strongest economy within the Eurozone that will probably be able to deal with the ECB tightening of monetary policy and high interest rates much better compared to some of the other nations that may find it more difficult. So for the likes of Hungary, which has been quite rebellious when it comes to the rule of law with the European Union itself. So when it comes to, paying back any debt that those nations have via their commercial banks or borrowing that they've done from the ECB, particularly Greece with a high debt, Italy as well with huge debt as well, those nations might face a tougher situation, have a tougher scenario compared to some of the other nations that maybe have more sound fiscal policy and be able to weather the storm a bit better. Not saying that they're not going to be hit by the storm, but just saying that they have the ability to weather the storm a bit better compared to some of the other nations that won't be able to or don't have the backups that they need to be able to deal with those, or the finances to be able to deal with tighter monetary policy. So that's something that the ECB said that they will look to deploy, something that's going to be quite key for today's ECB meeting as well, something that's going to be needed and needs to be mentioned in a bit more detail as to how that will look. Then if we carry on, so the ECB said, so accordingly and in line with the ECB's policy sequencing or the route or the timeline, the ECB intends to raise interest rates by 25 basis points at its July monetary policy meeting. But so this is the key thing. Then the reason why, and we'll look at the deviations. If you were trading the euro, or you were looking at the markets in general, you would know that from the prior meeting that we had prior stream that I did for the ECB, is that markets were pricing in a 50 basis point hike for the July meeting. So they were expecting the ECB to mention an openness to a 50 basis point hike at the July meeting, but we didn't get that comment. Instead, they said they're going to stick with what they're already intending to do, which is a 25 basis point hike. Now, the euro had declined and weakened off of the back of that comment from the ECB. So, key thing to note is, you're going to get the rate decision for a 25 basis point hike, both in the deposit and the refinancing rate or the interest rate. But we've also got to be aware of the comments that are coming through as well. So I'll try and at the same time go through the comments as best as I can to try and marry up what's going on with the markets and what the ECB has said. But that's the key thing. That's why the euro had weakened, because of the expectation that there was for the ECB to say, okay, in July we're going to go for a 50, but they didn't. So we'll go through the deviations in a bit more detail. So the post ECB then. So Thursday's meeting, some ECB members wanted a 50 basis point hike in July. That was according to sources. So this is an issue with communication with monetary policy. And similarly to the Bank of England, they take a rate hike they take a rate decision that isn't expected. And then after the rate decision happened, then they say what was supposed to happen, basically, or what the markets were expecting to happen. So you may have in the Bank of England, they were expecting to raise rates, sooner, but they didn't. And then they say we need to raise rates. And same with the ECB. Is again they're saying markets looking, the ECB members are looking for a 50 basis point hike, but not mentioning it. Not mentioning it in the ECB meeting minutes or prior to the release, or even taking the 50, or even saying, it's a definite, we're going to do a 50 basis point hike in July rather than 25. So that's, but it is some members. So more or less, those would be the very hawkish members like Nagel, Holtzman, that would look for, and ECB's not, that would look for a 50 basis point rate hike instead of a 25, compared to the more of the other dovish members. Then, so the bets and expectations then. So 15th of July had money markets that are wagering on 30 basis point hikes at the this week's meeting. So looking for 25, and then 91 basis point hike of tightening by September. 91 basis points of tightening by September. So more or less looking for 50 on both the 50 on both the rates. Other than that, so as well, when we're looking at market expectations and what money markets were doing, so you can see here, this is just a nice little image that I found from a Bloomberg article here. Money markets, so you're looking that they were looking for around a 200 basis point hike, right, in total by the year end. But of course, that had declined, of course, after the other rate decision where they said they will look to hike in 50 basis points in July. And that's why the wagering had gone down to around 150 basis points by the year end. But that's something to be aware of, is that the ECB really hasn't been phased by what the markets have been predicting or looking to predict. Whereas in the US, traders, if they see a high CPI figure, they know that they have a feeling that the central bank will take a 75 basis point hike at the next meeting, which is what the Federal Reserve did. So the markets, so the Fed, more or less reliant on data as much as the traders and economists are, and taking the expected move of 75. So could that happen today with the ECB if they weren't really phased by the market expectation of saying a 50 basis point hike in July? Maybe not, but there is that possibility still there, knowing that how we have been surprised by the Bank of Canada when everyone was expecting a 75 basis point hike and they went with a 100 basis point hike instead. And of course with the Swiss National Bank as well, the SNB taking a surprise 50 basis point hike from minus 0.75% to minus 0.25%. Then ECB member views as well. Of course, is quite key to gauge what traders are feeling and what they're also feeling as well. So ECB's Ren said that ECB is likely to hike by 25 basis points in July. There's some July 15th and 50 basis points in September. July 8th, Visco said that inflation is to spike this year and go back to 2% in 2024. A rate hike bigger than 25 basis point hikes, 25 basis points could be appropriate in September if medium-term inflation expectations don't improve. Okay, and then 4th of July on what I call Traders Day from the US with the 4th of July Independence Day. ECB's de Guindos said that if Russia cuts off gas in the euro area, we might have a recession. And that's something that's also been cited by the IMF too recently this week. They said that if you do have a cut-off of Russian supply to the Eurozone area, then you could see a drop in GDP by 1.5%. Which has been mentioned by the IMF this week, and also taking a toll on the German economy as well, of course, being the biggest economy within the Eurozone. Schnabel said that markets anticipate a higher terminal rate, but didn't really say we're looking for 50 at the July meeting. Just kind of, just kind of open it up to the, to traders to kind of figure out what that means. And whether or not they should price in a higher rate hike. ECB's watch. So this is what I wanted to kind of, calculate and just kind of get through. So ECB's watch on the 29th of June. So they had said that 150 basis point hikes by March is reasonable. Now that will be 6 meetings, including this one, which would be 25 basis point hikes at each of those meetings. Now, key thing is that if markets are if at the September meeting they're looking for a 50, then we have, we'll get to the rate of 1.5% for the interest rate before March by the year end, and the deposit rate would reach 1% before the end of the year. But if we were looking at Wunsch's estimates, and if they were looking for a 25 basis point hike instead, then you probably by March you'd get to 1.5, and the deposit rate to 1% by March. So that's just one thing to bear in mind, is that with tighter monetary policy, all you need to know is that within 6 meetings, if they do go for a 50 basis point hike, they'll reach the interest rate, or they'll be done with 150 basis points before the end of the year, rather than what some were expecting, such as the ECB's watch back in June, of reaching that rate by March. Now, it's not to say that that's a specific figure where the ECB is going to stop. That's just going off of what one of the ECB members has said, that they could do 150 basis points by March being quite reasonable as to how quick they can be with raising interest rates. So now, the views then from investment banks. So Rabobank FX strategist Foley said they're fully priced in 25 basis point rate hike by the ECB is unlikely to prevent the euro from plummeting, especially given the market's rising attention on the Eurozone recession fears. Even a 50 basis point advance this month may be insufficient to support the euro. So one view saying that maybe even a 50 basis point hike surprise might not be enough to keep the euro from going down from recessionary fears. Remember, when interest rates are raised, that brings up the value of the currency. Okay. And stock markets don't like higher rates of interest rate because they have to pay more for borrowing, for borrowing money, and also paying back any debt. And then for bonds, you've got to consider that for bonds, if you do get a high rate of interest, short-term rates see the biggest appreciation, and in turn, long-term bond yields. Remember, just talking about yields here, see an appreciation as well. So that's the key thing. So 25 basis points, according to Rabobank's strategist Foley, saying that's not enough. That's not going to be enough if that does happen at the meeting. Citi, they say that strategists look ahead to the ECB's policy outcome in September, and they suggest a 100 basis point increase may be possible, with a 25 basis point hike already as a done deal. So at the September meeting, there could be a 100 basis point hike, according to what they're saying, or what Citi expects. And the ECB may need to send a strong signal that a raise greater than 50 basis points is on the table in September, and saying that 50 basis points may become 75 and then may become 100 basis points. Key thing is the investment banks are saying that 25 basis points is not going to be enough to kind of keep the euro up, and that they need a bigger rate hike decision to be made in order to kind of support the euro. And then ING, they say they still expect a heated debate on whether or not 50 basis point could be possible. And that's so one of the head of macro at ING said that he doesn't exclude that option there. So again, the 50 basis point is still open with that there as a potential for a surprise there. Then other areas too. So TD Securities, they said that the ECB will need to build expectations that they will continue to raise rates even if the Eurozone faces a recession in the second half, as inflation will put the ECB under pressure through autumn. So the key mandate for everyone at the moment is to bring down inflationary pressures, as such as what the Bank of Canada did, saying that they underestimated the inflation. You know, a lot of them said that it's going to be transitory. Well, they said it. There's a fear of it becoming entrenched. So go figure, huh? So Bank of America also said this week as well that the ECB is to signal an end of an era this week, and they expect a 25 basis point hike is more 25 basis point. I expect 25 basis point, but more is not unthinkable. So there's an opportunity or the possibility for a stronger rate hike. And Lagarde will likely leave the door open for more than a 50 basis point hike in September. Goldman Sachs, they also see the ECB raising their rates by 50 basis point in September and October as well. So remember that one thing that I said about seeing 150 basis points by March in total? Well, of course, investment banks are looking for a shorter time length. So before by the end of the year, we'd get to 1.5% for the rate, refinancing rate, and 1% for the deposit rate. That's if if they do take, a 50 basis point hike at one or two of the meetings, but if they do go for 100 basis point hike, then we get there much sooner. Then other areas, so recession, how near is it and how bad could it be? So Goldman Sachs, so this is the key thing sentiment-wise that the markets have been focusing on. So if Goldman Sachs said that if Russian gas flows resume at a moderate level, the Eurozone will be on the verge of the recession in the second half of 2022, with inflation reaching above 10% in September. The rate could be lifted by 150 basis points by the end of this year in total, warning that slower hikes if an energy shutoff causes sharper contraction and faster price growth. UBS also said that amid a moderate consumer-led recession caused by higher energy costs, the ECB in that scenario would suspend rate hikes could suspend rate hikes in December and February, but then resume them. And a gas shutdown, on the other hand, would end after the scheduled hikes in July and September. So again, the ECB could take if there is a full-on gas shutdown and there isn't, businesses don't have that big old Russian supply of energy or natural gas, then the ECB could actually stop hiking rates and actually might go the opposite direction instead to try and support those businesses that are dealing with higher rates for natural gas instead. ING also added that they expect the Eurozone economy will fall with or without a Russian energy cutoff, and the ECB is generally more responsive to growth even if prices stay high. JP Morgan say increased growth sensitivity does not rule out rate normalization entirely, and the ECB will have to make painful decisions. Okay, so then ING then with their crib sheet, always very useful. The key comments then to be aware of, what to look out for, and if you don't understand, dovish means that they will likely central bankers look to keep monetary policy as a way to support the economy by cutting rates or maybe loosening up on tightening monetary policy, maybe not seeing the economy as strong as they think it would be. And then hawkish being the opposite end, just meaning that the economy is doing well, maybe inflation is really high, maybe there are other areas within the economy that are doing much better than expected. So again, hawkish means that they'll look for tighter monetary policy, i.e. maybe raising rates or tighter removal of asset purchases, making sure that any sort of fragmentation tool or any sort of asset purchases don't exist, basically. So the current stance, of course, you've got there, as you can see there, headline inflation slightly above target at the end of the projection horizon. So ING's basic case scenario of the neutral area, they say the inflation is to remain high and decline to slightly above target in the medium term. And then also mounting downside risks, but conditions are still in place for growth. So growth outlook, interest rate saying a 25 basis point hike for July and signaling a 50 basis point option on the table for September. Fragmentation tool with some conditionality and few details. So again, quantitative easing there. And the flip side, on the hawkish side, if they said that inflation is seen persistently above target in projection period, stressing that downside risks are temporary and outlook is strong beyond that, and then going for a 50 basis point hike as well at this meeting, and then a 50 basis point hike or 75 in September. So again, being open to saying, for myself, if they're already saying they're open to a bigger rate hike in September, to market saying that could be 50, I'd expect to look for comments for a 75 basis point hike to really see some strengthening from the euro. Fragmentation tool with very strict conditionality and size is limited. So being very stringent and with the fragmentation tool of asset purchases to certain countries that may not be able to deal with these higher rates and tighter monetary policy. Okay. So that's what ING sees as their base case scenario on the hawkish side, and of course you have the dovish side where they flip the switch and they say that they will look for a no more than a 25 basis point hike in September, which would remove their credibility if they had already said, which would slightly erode their credibility if they were looking for a 50 or bigger rate hike. Potentially bigger rate hike in September, dependent on data. But if they do say that they're looking for no more than a 25 basis point hike in September, that's, they've given you a figure. They haven't mentioned the 50, and that's not something is going, terribly wrong within the Eurozone economy. And then, of course, looking for an unlimited, being unlimited in providing that fragmentation tool and providing those asset purchases. So that's ING. If we look at some of the other areas too, so they said the 25 basis point rate hike and openness to a 50 move in September may fall slightly short on market expectations and add some pressure to the euro this week. The ECB is unhappy with the weak euro, but its ability to offer sustainable support to the currency may continue to prove limited. So again, that's from ING's comments of what they believe the ECB could do and how that could affect the euro as well. Then, if we look at the previous rate decision, then if we go through that here, okay, so hopefully you can kind of see that clearly. So you'd see. Let me go back a little bit. Oop. Excuse me. Get this here. I'll try and go back. All right. So that was the rate decision. It come out there. So there was no change there. Then there were a bunch of headlines that had come through. Key thing is that you had seen that the euro. So it took a little bit of time. Right, it wasn't like an instant thing. So traders were also waiting on the monetary policy report as well. And then you had that headline that they were, when I looked through it, that they were looking to actually, they'll do a 25 basis point rate hike in July rather than what the markets were expecting. We're looking for a 50. And then what happened was, and then of course saying that later on they said they'll be open to a potentially bigger rate hike in September, dependent on data. So that was the previous report that we had seen there from the ECB. And again, so if we get out of this, and then if we look at the deviations, then let me just bring that over here. Oh, 1 second, peeps. Okay, bring over the deviations. Here we go. Now, here we are. So the key thing was there wasn't a mention that they didn't say they were looking for a 50 base point hike in July. They were looking for a 25 in July and open to a potentially bigger rate hike in September. So this is how the markets reacted. So the Stoxx 50 was up 17 ticks. And then after about 10 minutes of trading was down 15 ticks. The euro dollar went down by 54.5 pips. And then after about 10 minutes of trading was up about 3.8 pips. Euro GBP was down 27.8 pips and then up about 1.4 pips. The key to remember is that the other comment, so the initial movement down of not seeing a 50 base point hike in July and then being open to a bigger rate hike in September. That's why you didn't see that complete sustained move after about 10 minutes of trading, and you'd seen a bit of a reversal happening on the euro. Euro JPY had seen the biggest move of 77.7 pips. Whoops, that should be down, not up, on there. 77.7 pips down. Euro Swiss franc had seen 32.3 pips down. Euro New Zealand dollar 66.9 pips down. And Euro Aussie dollar had seen about 67.5 pips down as well. So you can see that on the Euro JPY, kind of sustained this move. It was down by 18.3 pips after that. And on the Euro Swiss franc, it nearly, removed all of its, or raised all of its gains on the initial, after the initial move. It was only down by 1.4 pips, whereas the New Zealand dollar and Aussie dollar was still down about 7.5 and about 4 pips. The key thing is to remember is that the Euro JPY had the biggest market reaction out of that last time. Of course, at that point, they were they're still looking to ease monetary policy and keep easy monetary policy, and they're definitely not looking to raise rates. So could that mean today that you see the Euro JPY see the biggest mover today? You've got to remember that there was the last week that we had the euro had hit a 20-year low against the dollar. We had seen that the euro had a bigger reaction to some of the releases compared to the Japanese yen. But now that is, of course, it's the ECB rate decision, is maybe falling back on the Japanese yen again being the weakest currency compared to all the other big currencies. That we could see the biggest reaction on the Japanese yen again. Also, Eurobond futures also had seen about 70 ticks up, and then after about 10 minutes of trading, it's about 77 ticks down. So that was the deviation then that we had from the rates decision. Now, key thing of expectations then. So with a 25 base point hike, we're not expecting that big of a reaction or a move from the market. So more or less has been priced in. So you're not, again, as said, you're not really expecting big moves from the market. Just seeing some other comments too. German gas storage facilities are to be filled to 85% by October 1st versus previous 80%. Germany is looking to tighten installation of gas storage levels according to a draft. Okay. Just seeing if there's anything with the gas stuff here. If Russian supplies remain via Nord Stream 1 remain at current low level, 90% storage level by November, will hardly be reachable. Yada yada yada. Okay, that's interesting. Russia plans annexation votes in Ukraine region by September 15th. Luhansk and Donetsk, probably. Okay, and Draghi finally resigned as well. Okay, so so the Draghi stuff was also quite interesting yesterday as well. Even though he won the vote of no confidence twice, of course he did ask for he didn't specifically say let me resign. Poor guy, he's been trying to get out of it, get out of that position. Of course, he didn't get the support from the Five Star Movement Party, one of the main parties in Italy. So he didn't really get huge backing. Meaning that it was going to be harder to pass legislation that was more or less needed. But anyway, so what we're expecting is, I think, if you're looking for a stronger or appreciation from the euro or an appreciation from the euro, you'd be wanting to look for at least a 50 on both the rates, right? At least a 50 basis point rate hike. As said, the 25 basis point hike is already priced in, so you wouldn't see. You might see a bit of a blip, a lot of whipsawing in the markets. And again, if 25 basis points is done, or if it does happen, there is a potential for a movement towards the downside instead. The only reason why I say that is when the Bank of England were expected to, or if traders were expecting them to raise by 50 basis points, and they only did a 25 basis point hike to 1.25%, the pound or sterling had plummeted off of basically the data coming in line with the forecast. It wasn't better than expected. What traders have started to look to price in for a bigger rate decision from the ECB, from the Bank of England. So we could have the same scenario here, where the 25 basis point hike coming in as expected could see the euro moving towards the downside instead, rather than seeing a blip move towards the upside and then kind of reversing, kind of whipsawing here and there, and then carrying on its movement. It could actually be a more of a negative thing for the euro instead. But again, key thing, as I said, at least a 50 basis point rate hike would be needed to kind of satisfy the markets or satisfy euro traders if they're looking to buy into it. So we've got about 12 minutes left until the rate decision. So of course, remember with Financial Juice, where we're going to be getting the live data and the headlines in real time as well. Key thing to remember is that we have a 7-day free trial of Financial Juice Pro, right? If you're not familiar with Financial Juice, we're of course a live voice and text service, that we provide of the big macro moving news. And we try and keep you up to date as best as we can as to why the markets might be moving in a certain way. Like yesterday, we had Google that had, after about maybe 5 minutes of the NQ seeing a movement towards the downside, there was some news that actually Google was looking to pause hiring for a couple of weeks. Then we had, searched that up and found out that the news had come out earlier, at the market reaction before the actual headline that came out itself. So that's what we look to do, to try and provide you with the best up-to-date knowledge of what's going on within the markets as soon as we can and as best we can. So Financial Juice Pro, there's no adverts, there's no delays to the service or to the voice or text feed. And also, of course, with the data as well, no delay to that at all. You can also set your, you can also set your economic triggers as well. So if we're talking about economic triggers, what we're talking about is that if ignore this figure here. So if you're looking for, let's say, a 50 basis point rate hike, and let's say you're saying you'd only buy the euro if it comes out of spot, let's say for the main one on spot 5%, okay, and sell if it's let's say it's unchanged, right? Which would be a very big surprise. If the ECB decides to remain, unchanged with the rate decision, then you'd see some heavy selling going on from the euro. But that's what you can do. So if it matches when the economic release figures come out, and if it matches your trigger for the economic release or the figure that you've put in, again, remember the initial other figures that we had here. That's just showing the forecast figure. That's not us telling you what to do. What it'll do is it will pop up with a little buy or sell signal here for you, depending on whether or not it met your trigger. And that's also real time as well. Of course, on the other version or the light version, that's not real time, that's delayed. So I'm going to pin this message here for you for the Financial Juice Pro, a 7-day free trial. Also, got to get my tick strike up. So tick strike 2. So if you like to, if you want to measure order flow, how strong movement momentum that there is behind, a certain asset, then you can have a look at tick strike. Tick strike allows you to list order flow in futures, forex, and stock instruments, crypto, ETFs, ETNs. We have a load of different instruments that you can have a look at for tick strike. So we also have a 7-day free trial of that as well. Now, if we're looking at the little numbers here, so the little numbers here, whoops, there we go. So the little numbers going off here and there, basically means 1 is the most sensitive to market reactions. So if you do see a little bit of selling or buying, and it meets the initial trigger for the alert to go off, such as here, then it will alert you via visually and audibly as well. Of course, at the moment I've got the sound turned off, otherwise you can hear a lot of tick, 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 tick sounds, which we don't need at the moment. But you can, if that's what you prefer, then by all means go ahead. And then if you raise that level all the way to 15 is the least sensitive. So 15 means you're looking for big movements in the markets or in the instrument, the particular instrument you're looking at, for big amount of buying momentum or selling momentum, and only then will tick strike go off with an alert or a visual aid. So that's tick strike there for you. That's a 7-day free trial. We've got about 4 minutes until the rate decision. 4 minutes. And then if you've liked the content that I provided you and you found it useful, then don't forget to like and share this video, and also subscribe to the channel. As well, and also follow us on Twitter too. So I've put a link in there for you to follow us on Twitter as well. And then of course, with the macros mailing list, with this, what I do is I do like a week ahead report on a Sunday evening. I put that out with what to expect for the different sessions for Asia, Europe, US, the releases that I'll be covering, and also the economic, and also the other weekend bits of news that have come out. And I put that all into one little report for you that you can have a look at as well. And of course we provide the deviations for the economic releases as well, for the upcoming economic releases, and then also the live stream links for you in that email. So you can sign up to the macros mailing list. Again, if you found the content useful, then definitely go ahead and sign up there. We've got about 2 minutes. And then finally, of course, we have a new product that we've launched, unusual activity, or relaunch of it. Now, if you like to trade unusual volumes activity in stocks, then you can join the free beta test group of our new service of unusual activity. So, looking at different industries and sectors. If you're a stock trader, then this is more or less the perfect thing for you to have a little play with and use. Again, it's free, and you can be a beta tester, give us your thoughts and feedback as to how we can improve it. But that link is there for you. All right. So I managed to do the prep, all the little adverts for you, and we've got about just over a minute to spare. So I think we'll just kind of sit back and watch what happens. Let's look at the Europe bond futures. Let's get that up too. Okay, go about a minute. Okay, so usually with the bond prices or the bond prices, what would happen if you do see a high rate of interest, then the bond prices would tend to head lower, and the yields would head higher. Of course, when interest rates raise, it's the short-term rates that see the biggest appreciation. So you'd expect some for the bond price. For the Eurobond price to see some weakening, and the yield to see some strengthening. All right, we got about 12 seconds and 10 seconds now. All right, here we go. Let's see what kind of a rodeo we get. Okay, it's taking a bit long. Market's trying to... Well, this is... Hike, 20, that's a 50 base point hike, 50 base point hike to spot 5%. That's higher than the expected 25 base point hike, seeing the euro strengthening off of the back of that there. And the ECB deposit rate, 50 base point hike, 50 base point hike to 0%. That's higher than the expected 25 base point hike. So the ECB going for a 50 base point hike on both the interest rates, and seeing euro strengthening off the back of that data there. So the ECB saying that today, in line with ECB's strong commitment to its price stability mandate, ECB took further key steps to make sure inflation returns to its 2% target over the medium term. Let's have a look else as well. What else we got? It's going through. They judged that it was appropriate to take a larger step first on its policy rate normalization than signaled at its previous meeting. I want to look at what they're expecting. Okay, here we go. ECB says accordingly, interest rates on the main refinancing operations and interest rates on the marginal lending facility and deposit facility will be increased by 0.5%, 0.75%, and 0% respectively with the effects. Okay, that's fine. That's not for the future. Ignore that a little bit. Trying to look at what they're going to do for September. It's not coming through here. So they raised their marginal lending facility by 50 basis points to spot 75%. Let's see what we got. Wow, okay. So they're out of the negative interest rate range now. So again, a 50 basis point hike. So ECB seeing further normalization of interest rates. Where's the September stuff? That's what I'm looking for. Okay, so we'd seen the Eurostoxx 600 down 0.4% after the ECB rate hike. It was previously down by 0.1%. Let's look at the Eurobonds. There we go. Yep. Bond prices have gone down as expected, so the yield would go up. Okay, what else we got? Why is there no mention of what they're going to do for September? Okay, well, I can't say anything for September, but hey, there you go. 50 basis point hike, huh? Surprise the markets a little bit, but, kind of meeting market expectations of what, looking for a 50 basis point hike. If we did get 25, you would have seen the opposite reaction there. So that's a good thing. Let's see. I think they'll probably be open to a 100 basis point hike, maybe what Citi said in September, if they've gone for a 50 basis point hike now. On both on all their rates. Just saying that future policy rate path will continue to be data dependent. All right. Don't tell us then. All right. Keep your secrets. Okay, let's do some measurements then. Euro JPY. Let's see if the Euro JPY was the biggest mover. It was. Okay, that's... Get that correct. About 71.6 pips. So what you got? Euro dollar. Well, I should do Euro GBP next, but okay, it's about 50. Similar to the other reaction that we had last time. To be honest, we had about last time we had about 54.5 pip move. Down. Now we're seeing 50 or 51 pip move towards the upside. Euro GBP. Let's see what you got, baby. Right. Wow. Okay. That didn't see it. Big of a reaction. It's about 34.5 pips. Let's look at the Eurobonds. See what you did. It's 102 ticks down. Dang. Right. What else had the biggest move? So let's look at the Euro New Zealand dollar. Whilst I'm doing this measurement, did anyone trade that release there, or you kind of just waiting to see what happens? Let me know if you did, and hopefully, if you're using the information that I gave you, hopefully you found that useful. It's about 69 pips up on the Euro New Zealand dollar, so it's still the biggest mover from the Japanese yen. It was about 70-ish. Oops. Yeah, about 70 pip move towards the upside on the Euro New Zealand dollar. Let's look at the Euro AUD. Well, tick strike is still showing some strong momentum towards the upside for the euro, or buying momentum at the moment. Well, I've literally remember I've just left it on the level 1 sensitivity, but still seeing some buying going on. All right. It's about 65.6 pips, or 65.5 pips. Okay, and then finally, Euro Swiss franc. And okay, that's all the smallest move out of all the other ones. All right, that was a 25 pip move towards the upside. Right, then, so that kind of confirmed then. So with the easing of, or continuation of easing monetary policy by the Bank of Japan, or looking to, continue to ease monetary policy, keep it easy. Japanese yen had the Euro JPY had the biggest market reaction currency-wise, with 71.5 pips. It'd probably be slightly bigger than that, but 71.5 pips towards the upside there on the Euro JPY. And then what do we have next? We had the Euro New Zealand dollar with 70.8 pips towards the upside. Euro Aussie dollar was 65.5. And then Euro USD with 50.9. Euro GBP with 34.6 or 34.5. Okay. Ooh, the traders bet on a 60 basis point of ECB rate hikes in September. Okay, ECB decided. That's what he said there. Yeah. So they're looking for a 60 basis point. Oh well, obviously it'll be 50 at least in September. What else we got? Okay, so yeah, so Euro JPY had the biggest mover off of that data. Okay. All right. Thank you very much for joining me for that there and that rate decision. Hope you found that data useful. Or hope you found the things. The data that the report that I'd given you as useful. Somebody said, "Why is the stock market going up?" Well, Nicholas says, "Why did the stock market go up?" Then Tan Zi Heng says, "A merely 50 basis point, bringing it to zero, is still a huge divergence. By the way, the Fed and the ECB. What's your view on the euro dollar later?" Okay, so it depends what of course it's still blackout week from the Federal Reserve. So probably with this rate hike decision. Now, like I said, so markets were looking for a 50 basis point hike. So how long does this market reaction last for? Right, that's kind of yet to be yet to be seen. Um, if they were doing a 100 basis point rate hike, I think you would have seen the euro kind of continue on for the rest of the day, going higher and higher and higher, right? If they decided to go for a 100 basis point rate hike, which would be stupendously large and be much higher than expected. So the key thing is, I think for the euro dollar, you need to keep an eye out on other after the rate decisions come out, we're looking for what the sources say. If they're looking for a bigger rate hike in September by 100 basis points, and if they do say that, you'd expect some further appreciation in the euro dollar and the euro overall. But if we don't really get any of those comments, I think this movement depends. It might not last long, and we might until we get the press conference at 8:45 a.m. Eastern Time with Lagarde. If she doesn't really confirm a bigger rate hike for September, or if she doesn't say, if she doesn't confirm a 50 for September, or doesn't look for a 100 basis point hike for September or further down the line, then you could see the inverse reaction. You could see some weakening instead. The reason why is, if we're looking at the DAX 30, actually, let me get the Euro stocks up on here for you. Okay, all right, let's get this here. Let's see what we got. Let's look at the stocks then here. Stocks 50. Okay, so the reason why that would have occurred then is that you would have seen, of course, as I said before, 50 base point rate hike, was what markets had wanted. So we got that. We got that there. Now, if we didn't go any higher than that, if we did go higher than that, I think you would have seen some further weakening on the Euro Stocks 50 here, but we didn't because we didn't get a much bigger rate hike. If we got a 25 base point rate hike rather than a 50, you would have seen the inverse reaction here. You would have seen the stocks, you would have seen it go fly up instead rather than going down. But I think as long as the potential is that if there is a continuation of euro pressure towards the upside, then this movement might not last too long. But again, that's yet to be seen. I cannot speculate, only as much as I can from what I can see from the market reactions. But yeah, that's a possibility. It might not happen. It might happen. But anyways, so yeah, that's the reason why. So you got a 50. You didn't get anything bigger than that, and you didn't get any other major surprises. Hence, you've seen, of course, the initial move towards the downside for about a couple of minutes, and then kind of peeling away, and then going back towards the upside instead. Okay, right. Let's actually see what you did. It's a good point, actually. Let's see, how far did you go? Whoops. Okay, so it's sort of about 26 ticks towards the downside there. Righty. Okay, that concludes Macro Ace. Thank you very much for joining me live. Hopefully, as I said, you found the information useful. Don't forget to like and share the video if you found it very useful, and for the future. Don't forget to also sign up to the mailing list too. So I'll grab that. I'll pin that to the top, so you can see that there. So you can sign up to the mailing list to receive, the week ahead report of what to expect. I am mulling doing a market wrap sort of thing, for the end of the week as like a video or like an audio feed as well for you, rather than just text. If that's something that people are interested listening to, like an audio feed, then that sounds good. Then I think I'll go ahead and do that. All right. So Scotch and Stock saying thank you, good sir. Paul Santos saying dollar down, stocks up. Where to get OIS chart? Have to know when it's priced in. Thanks, sir. Gas normalization will strengthen the euro. So I guess the key thing for whether or not it's priced in is how is the euro reacting when you get comments from, when you do get inflation readings? Does it start to go up? Do you see comments such as this where traders, if I bring it out of the way, where traders are betting on a 60 base point rate hike on, for ECB rate hikes in September, that sort of stuff. That's what you've kind of got to look out for, and then you kind of know, what traders are expecting ahead. Anyways, thank you very much. That is Macro Race for the week. I hope you enjoyed the CPI yesterday, or Canadian CPI yesterday, and I hope you enjoyed this as well. All right. Thank you very much. Take care and goodbye.